Well, we spoke earlier of projects that might not be of the same risk as the average of the firm's projects. And we said we might have to adjust that required rate of return, either up or down, because these projects are of different risk, either more or less than the overall firm average risk, because that average risk is what's driving the market required rate of return of their sources of capital. So now for an individual project, we've got something called the pure play method. And it's a little more complex than some of the things we've had to deal with here. But let's go through it. It says calculate the cost of equity for the project using this pure play method. So the first step is calculate the cost of debt for the company. And then we're going to calculate the cost of capital for the project using the debt equity ratio of the subject company and the WACC formula. So we've got our pure play company. The subject company is the company that we're trying to estimate the cost of this project, the cost of capital for this project. So we're going to calculate the beta of this comparable pure play company. So we've got a firm, and we've been in the salty snacks business, and we decided that we want to branch out into the restaurant business. And we've got an opportunity there we're trying to analyze. Well, the risk of this restaurant business may be quite different from our salty snacks and beverage company risk. So what we can do is we'll go out and we'll find a company that's just in, say we're looking at fast casual restaurant. So we go out and find a company that's purely in the fast casual restaurant. And so we calculate the beta of that company, and then we're going to adjust it to match our company. So the first thing we do is we're going to unlever it, because the firm's use of debt in their capital structure, different levels of debt can give us a different beta. So we're going to take out the effects of that financial leverage. And really you can think of this, well, what would be the beta if this was just an all equity firm? And that's the asset beta. So we calculate that. We unlever it to get the asset beta. Once we have the asset beta, then we can re-lever it using our company's debt equity ratio and sometimes our company's tax rate. So we've unlevered it to get the asset beta, and then we'll re-lever it to get the cost of equity capital given our corporate structure and amount of leverage that we use. So then we can use this project beta for our company to calculate the cost of equity for the project and use that with the cost of preferred and the cost of debt in our overall calculation, or I should say estimation, of the weighted average cost of capital. So there's the formula you need to remember. The learning outcome statement here says calculate and interpret. So this is how we unlever the beta. We multiply by this term here. So this is the tax rate and the debt equity ratio of the pure play company. So we unlever it, and now we've got the asset beta. We've got the all equity beta, if you will. And so once we have that, then we're going to use this same term, but instead of dividing by this right here, we're going to multiply by that to re-lever that beta. And we're going to re-lever it. Now, this is our company's tax rate and our company's leverage ratio, debt to equity ratio. And so now we've got the beta for the project. Well, what are we going to do with the beta? Well, we've only really got one move with the beta. Okay? We're going to use the capital asset pricing model to calculate the cost of common equity. So if our subject firm's debt equity ratio is 2, our tax rate is 40%, our debt yield is 14%, our pure play firm has a debt equity ratio, a little less leverage than we do at 1.5, a little lower tax rate for whatever reasons, and an equity beta, that's what we're starting out with, of 0.9. So what's our first step here? Well, our first step is to unlever that beta based on the pure play firm's debt to equity ratio and tax rate, and see that that's 0.439. But now our firm has some financial leverage, so we're going to re-lever this beta, the asset beta, by multiplying by this, and now it's our tax rate and our debt equity ratio that go in there, and so we get a beta for the project of 0.966. Well, once we have that, then we need the risk-free rate and the expected return on the market, so we can plug that project beta of 0.966 in to our capital asset pricing model formula. And there it is there. We get we expect to earn 5% plus 0.966 is really close to 1 unit of market risk times that market risk premium. Here's 7%, the difference between the expected return on the market and the risk-free rate. And so we get a cost of equity for this project of 11.762%. Well, we've got three past the decimal point there. I don't want you to come away with the idea that we're actually measuring things that precisely. This is an estimate. So, continuing with our calculation or estimation of the project cost of capital, we've got to come up with the firm's weights for debt and equity. We don't have any preferred stock here for this example, so we just need the weights on debt and equity. Well, we can get those from the debt to equity ratio. Just take that debt to equity ratio as 2 and say, well, let's let equity equal 1. And so if equity equals 1, then debt equals 2. Well, right away we know that debt is 2/3 and equity is 1/3, but let's follow that through. So our weight in debt is debt over debt plus equity, right? Our debt to assets ratio. So that's 2 over 2 plus 1 using our kind of ad hoc plug-in values of 1 and 2. And we get 2/3 as our weight in debt, or 0.67, giving us a weight of 1/3, 0.33 of equity. And there's that there. 1 minus the weight in debt is our weight in equity here. So once we have those, we can calculate our project weighted average cost of capital here. Here's our weights right here. Here is our cost of debt adjusted for tax. Here is the cost of equity that we got from unlevering and relevering the project beta from our pure play firm, and then plugging into the weighted average cost of capital formula. Oh, we had a quick stop there at the CAP-M to get the required rate of return on equity using the beta that we calculated for our firm, or for this project in the context of our firm. We need to know what to do with a country risk premium. We don't need to know a lot more than that. And here's one suggested way. The idea is that the CAP-M, the capital asset pricing model, is problematic for estimating the project cost of equity if we're looking at a developing market, because that beta we're using based on our own markets is not the appropriate one to use. And the suggestion is that given a country risk premium, which we don't have to calculate, we just add that. So the premium you're going to get in equilibrium in these developing markets is the excess return over the risk-free rate, our market risk premium for our market, plus an additional premium for the additional risk and the extra returns for the additional risk of investing in this developing country. Now, one way to calculate, and you don't have to calculate this, this is just one way that's suggested to come up with a country risk premium, and this is just an example of how it might be done. They start out with the sovereign yield spread. So that's on the sovereign debt of this developing country. But we need the country's debt to be denominated in the currency of the developed market. Because our term here, we're going to take that sovereign yield spread and we're going to multiply it by the annualized standard deviation of the equity index over the annualized standard deviation of the sovereign bond market in terms of the developed market currency. So they've got some sovereign bonds. The developing country has some sovereign bonds. They are priced in euros. And so now we're going to say, well, what's the adjustment we want to make? We'll take the sovereign yield spread, and then we're going to make this kind of adjustment for equity volatility, taking the ratio of the standard deviation of the equity index to the standard deviation of the bond index. So equity has greater variance than the bond market. If it's 30% larger, we've got 1.3 there. We multiply that times the sovereign yield spread. And one of the reasons I say this is only one way to do it is because this you can only do for a country that has some sovereign bonds that are denominated in the developed market currency. If they don't have that, this method clearly is not going to work. The marginal cost of capital, we talked about this earlier, the opportunity cost of an additional dollar of capital. But the weighted average cost of capital is what we're looking at, so it's the cost of an additional dollar. It's the weighted average cost of an additional dollar of capital spread out across these three sources. And we talked about that being upward sloping because as the capital budget increases and they're issuing more equity or they're issuing more debt, we said these costs can go up. That's how we got an upward sloping marginal cost of capital schedule. Well, we're going to refine that a little bit here. And here I've put these as more of a stepwise function so you can see that when we plotted this investment opportunity schedule, remember we plotted this to get our optimal capital budget, which is I star here, our optimal amount of investment in the current period. And so here's our first project, and it has an IRR of 20%. And here's our second project. And here's our third project. Okay. And we can compare these. And we come up with the same idea here, that as long as the internal rate of return on the project is greater than our cost of capital, this third project here, this investment right here, is a positive net present value investment. So that will increase the value of the firm. Beyond that, our next project in order of their IRRs here has an IRR that is less than the cost of capital. And we don't want to do that project. That would decrease the value of the firm. So the stepwise part of the investment opportunity schedule is clear. What we're going to look at and develop now is where are these, let me just clear this off, these increases here and here and here, where do those break points come from? Where do those jumps up in the marginal cost of capital schedule come from? So where do we have these break points? Well, that's the amount of new capital investment at which the WACC increases because one of its component costs of capital increases. And how do we calculate those break points? Well, it's pretty straightforward. It's the amount of capital at which the component's cost of capital changes by the weight of the component in the firm's capital structure. So let's say that if you raise more than 10 million in debt, your cost is going to go up from 5% go up to 6%. Well, where is this going to happen? Well, it depends on the weight in the capital structure. So let's say that debt is 40% and equity is 60%. So we're going to divide 10 million by 0.4, and we could get that should be what? 25. So at 25 million in total capital budget, that's where it goes up. Well, I think you'll understand this real well if I just go backwards and say, you know, when our total budget is 25 million, how much of that is debt? Well, debt's 40%. So we just go times 0.4 and we get that 10 million right back, right? So we're saying, well, at a total capital budget of 25 million, debt's 10 million of that. So that's where the weighted average cost jumps up because the cost of debt goes up from 5 to 6%. So let's look at an example here of that. Our cost of debt increases past $100 million borrowed. Cost of equity increases past $200 million issued. Capital structure is 40% debt, 60% equity. So what's our first break point? Well, our first break point is, well, it could be at 100 million for debt. So our break point for debt tells us that, well, when we raise a total of 250 million, that means that's 100 million of debt in our capital structure. So beyond that, we have a higher marginal cost of capital. So that's one of our break points. And the other one, simply the 200 million, where our cost of issuing equity jumps up, divided by the weight in equity of 0.6. So for a total capital budget of 333 million, that's where we're just using up that 200 million of equity, and raising anything beyond that is going to increase our cost of equity. That component cost increases beyond 200 million issuance of new equity. So that sums it up in that last sentence there. Flotation costs. When we have to pay costs of issuing new equity, how should we handle it? Well, clearly, the writers of the curriculum believe they've got the right way to do it, because the learning outcome statement says, well, what's the right way to do this? And don't do it the wrong way. Okay? So these fees charged by investment bankers for raising equity capital, the costs are less for raising debt. We don't really have an exact analogy to it for debt. But 2% to 7% issuing equity, so significant costs of issuance of new equity. Now, the incorrect way, which is how we used to teach it in corporate finance classes at the university and in the bad old days, we'd increase the cost of equity. Okay, so our discount rate for all of this, our component cost of equity would be higher. The correct way, especially for the level 1 CFA exam, is to adjust the initial cash outflow, right, our CF0 in all our calculations of net present value, to include those flotation costs as if we had paid them directly. So let's look at an example of this calculation. Company raises $400,000 in capital to finance a project that will generate cash flows of $150,000 a year for 4 years. Cost of equity is 10.55. The after-tax cost of debt is 4.23, and our target capital structure is 50% debt and 50% equity. Flotation costs for equity are 4.5%. So we got to figure out how much equity we're raising, given our target capital structure. And then we can figure out our flotation costs, and then we can change our calculation of net present value by incorporating those flotation costs into the initial cash outlay. So there's our WACC. Our weights are 50-50, and we've got our costs of capital. So our weighted average cost of capital is 7.39. We're not going to adjust that for flotation costs. What we're going to adjust is that initial cash outflow. So we're raising half of that $400,000, issuing equity at a 4.5% cost of raising that equity. That's $9,000. So now we're going to subtract that $9,000, and we'll make our initial cash outlay not minus $400,000, but minus $409,000. And then this part of it, the present value of those future cash flows, is unchanged. So add those flotation costs to your project costs, your initial outlay. And that is the correct way of handling flotation costs.